Hey guys, welcome back to the channel. In today's video, I will talk about CPR, which is a revolutionary level-based indicator that can change the way you approach trading and the way you see the charts and improve it big time. We will learn about the CPR and floor pivots in greater detail with more emphasis on CPR indicator in particular so that you can create your edge over other market participants. The video is going to be longer than usual, but trust me, it's going to be worth it. Also, watch it till the end. And if you haven't subscribed to the channel yet, please make sure to subscribe and enable the bell icon so that you won't miss out on any upcoming videos. Also share it with your friends and fellow traders. Well then, this video will cover the following topics. We will start our discussion with the basics of CPR indicator, followed by the calculations of CPR and what exactly does this calculation mean to a trader. Then we will move on to the advantages of CPR and then to the uses of CPR. We will also discuss the significance of CPR indicator and we will shortly peek into the disadvantages of CPR. Then we will discuss about the general criteria for using floor pivots. And finally, we will end the video up with 2 CPR strategies that you can apply in the market. So without wasting any time, let's get started. Before starting with CPR, we have to understand how it came into being. For that, we should start our journey from floor pivots. See, floor pivots have been around for a long time and many traders have used these pivot levels to master the market for decades. Larry Williams, the famous stock and commodity trader, repopularized this formula of floor pivots by including it in his book, How I Made $1 Million Last Year Trading Commodities in the year 1979. In the book, he described the pivot price formula, which he used to arrive at the next day's probable price range, that is the high or the low. Nowadays, these pivots can go by many names in the market, including pivot points, floors, or just pivots. But we will call them floor pivots. The reason for this is simple but interesting, because they came popular once traders on the floors of the exchanges began to use them. The pivots served as a simple way for these floor traders to forecast the particular day's potential support and resistance levels, since they didn't have sophisticated computers and softwares on the floors of the exchanges back then. Another reason is that this name helps to distinguish them from other types of pivot points. Now coming back to the details, floor pivots are extremely powerful price-based support and resistance levels that are calculated using a prior period's high, low, and close prices. Actually, it offers an amazing way to view the market. They are like maps for the market, revealing the moves of the market even in the most uncertain times. So when we begin to study the pivots on a much deeper level, you will begin to observe the parallel nature that exists between the floor pivots and the price behavior. Now you may ask me, why in the world should I believe that these levels will work in the market? The main reason these pivots can be so unbelievably accurate is the simple fact that market participants are aware that these levels exist. Now they are watching them and trading these key levels every now and then. It all boils down to the trader psychology and human nature for that matter, which has remained the same for centuries, and the factors that run the market are the same: fear, greed, hope, and uncertainty. These are the reasons why traders continue to react to these key levels in the chart the same way over and over again. This is also the reason why these pivots have stood the test of time and will continue to work in the future. Now let us look at the standard floor pivots and then take our learning to a whole new level with slight modifications to the same. I will guide you through these topics based on my learnings from the very famous book Secret of Pivot Boss by Franklin Ochoa, for whom I am deeply indebted to, and I urge you to read the book because it has got a lot of valuable insights for all types of market participants. As I have mentioned, even though the floor pivots have been around for decades, they can still cause confusion due to the fact that there are several variations of the formula that can be found in the market. However, there is one such formula that is widely considered to be the standard one. So all you have to do is to plug in the high, low, and close of a prior day or a week or month, depending on the time frame on which you want to conduct your analysis, and the formula will automatically calculate the central pivot, 3 resistance levels, from R1 to R3 and 3 support levels from S1 to S3 that can be used for the current day's trading activity. That is, 7 pivot levels will be plotted on your chart. Now, do you know why the high, low and close are used for the equation? It is simply because they are the most important values for any given time period, whether it is a single 5-minute candle or an entire day or an entire month. In fact, the high and the low represent the most bullish and bearish expectations for the market for a given period of time, thus making these values an important reference point for the equation. Likewise, where the price closes gives an insight into the collective behavior of the market while heading into a future period of time. Now take a look at these equations. The pivot is calculated as an average on the 3 significant prices in a prior trading period or a prior trading day. All the other values are calculated from this basic value of the central pivot only. The standard floor pivots provides a lot of vital information about the prices. But in order to make the indicator exponentially more dynamic and responsive, we have to focus on some modifications. First of all, given today's volatile markets, just a third level of support and resistance can be quite shallow due to the explosive moves we see today. As a matter of fact, the volatility was less of a factor in the late 1980s and all, when the formula that Larry Williams produced offered only 2 levels of support and resistances. However, it is not going to gauge the moves that we experience these days. So we can add a 4th level or even a 5th level for that matter of support and resistances to the equation that falls in line with the general theme of original levels. So the addition of this 4th level of support and resistance helps to provide an extra target for those days when the market has exploded through the 3rd layer of the pivot levels. On top of that, taking the concept of pivot range from Mark Fisher's book, The Logical Trader, we can include a top and bottom pivot in relation to the central pivot of the indicator, which by itself is extremely powerful. Now these are the expanded floor pivots, which consist of a total of 11 levels. The central pivot range or CPR is an indicator that is used to identify key price levels to set up trades. CPR is quite beneficial if you are an intraday trader. The CPR consists of 3 components: a central pivot, a bottom central pivot that is below the central pivot, and a top central pivot that is above the central pivot. All these levels are derived out of the underlying high, low and close calculations of the previous day. So the central pivot is the average of the high, low and close, while the bottom central pivot is the average of high and low of the previous day, while the top central pivot is the sum of the pivot and the difference of pivot and the bottom central pivot. If you understand the formula closely, one thing you will instantly notice is that these equations are simple averages and manipulation to these averages. So as a thumb rule, in any technical indicator, the moment you see averages, you need to associate the indicator with an underlying trend. The CPR indicator does just this. That is, it helps the trader identify key price points and the associated trend around these price points. But there is a lot more to CPR which makes it extremely special. We will get back to this in a bit, but let us briefly discuss the advantages of CPR first. The CPR is absolute without a doubt the most powerful part of floor pivots indicator. At any given time, the CPR range can be a support or resistance to the prices. It can also help to forecast with a good degree of accuracy if the next day will be having a trending or sideways price behavior. Can also dictate the price direction and also the price momentum. The CPR can tell you so much about the potential movement of the upcoming day and even how the prior day performed. Moreover, CPR is the same in all time frames, or these levels are constant throughout the day. For example, if you have used the previous day data for the calculation of today's CPR, then the CPR will remain the same in the 1-minute chart, 5-minute chart or 15-minute or even 1-hour charts for that day, and it does not change as constant values are used for calculation. Many people think that the central pivot range is helpful only for intraday trading, but this is not true. There are many traders out there who use CPR for both intraday as well as swing trading. And it is also a very powerful concept that can be very beneficial to every trader if he knows how to use it correctly. So if you are using TradingView, then you can make use of the CPR indicator by Gomati Shankar from the TradingView indicators library. I personally use it myself. Now in the indicator setting, there are a lot of options to select from. But from an intraday perspective, we are only interested in the daily pivots, and maybe you can also use the previous day highs and lows, as these can be potential levels of interest in the market. Don't worry, we will discuss all of this in greater detail as we go through this video. One of the main characteristics of floor pivots and CPR is that these are leading indicators. Traders who use price-based indicator are using the earliest price information available. Traditional indicators are usually lagging indicators, which means that as soon as they confirm a move, most price-based traders have already identified a reversal and are already profiting in their trades. So the truth is that the best leading indicators are always price-based, be it the floor pivots, the Camarilla, the money zone, etc. Anything lagging and you will be trading from the back of the crowd instead of leading from the front. In addition to that, the fact that you can plot the next day's pivot is a breakthrough. Back then, it was a time-consuming task that included putting in values to the equations and plotting the lines in the chart, but now it is extremely easy. All you have to do is to uncheck the daily pivots from the indicator settings after the market closes in the evening, and then enable tomorrow's pivots, and you can straight away view tomorrow's ranges and levels with ease. This will help you analyze where the potential levels are for the next day and plan for different situations beforehand and set a strategy for each of these situations that is possible. The idea can be extended to other timeframes also in case of swing or positional traders by simply enabling the weekly and monthly pivots in contrast to the daily pivots. This idea of forecasting can get even better when we discuss pivot relations. But first, let me talk about pivot width forecasting. Since the prior day's trading activity leads to the creation of today's pivots, it is extremely important to understand how the market behaved on the prior day in order to forecast what may occur in the upcoming session. So more specifically, if the market experienced a wide range of movement in the prior session, as with a trending day, the pivots for the following day will likely be wider than normal, meaning that the distance between the top central pivot and the bottom central pivot will be very high or wide, which will usually lead to a range day or a sideways day where not much price action is expected. Conversely, if the market experiences a very quiet trading day in the prior session, the pivots for the following day are likely to be unusually tight or narrow, meaning that the top and the bottom central pivots will be very close to each other and will be very close to the central pivot also, which will typically lead to a trending day or a double distribution trend day where either a clear trending price action is visible or potential range breakouts and rallies are possible during the session. So it is important to understand the pivot width concept, as this information allows you to prepare properly for the specific day types in the upcoming session. So if you are able to anticipate the market's likely behavior, you are giving yourself the best chance at success because you are able to deploy specific trading setups that are tailored for certain types of days. So anytime you have an idea of how the market will behave in the following session, you are giving yourself a significant edge over the other traders. So as I have mentioned, when describing the width, I am referring to the distance between the top central pivot and the bottom central pivot, that is TC minus BC. Typically, an extremely tight central pivot range indicates that the market traded sideways or consolidated in a prior period of time. As such, this price behavior usually leads to a breakout or trending behavior in the following session, and conversely, an extremely wide central pivot range indicates the market experienced a wide range of movement in the prior day, which usually leads to sideways or trading behavior in the following session, as I mentioned. An important factor to note, however, is that the pivot width analysis works best when the range of the prior price movements is distinctly high or low, thereby creating unusually wide or unusually narrow pivots. What this means is that it must be clear that the width of the pivots is either abnormally wide or extremely narrow, as these are the sessions that grant us a higher probability of forecasting success. If the pivot width is not distinctly wide or narrow, it becomes challenging to predict the potential trading behavior with any degree of certainty for the next session. So you must also keep this in mind that this analysis is not without fault. Measuring pivot width gives you a significant edge in determining the potential behavior for the upcoming session, but unlike any form of technical analysis, this method is not always correct. Therefore, it is best to use it as a guideline. Now let us take a closer look at the pivot width relationship that can lead to one of the most explosive days in the market, the narrow pivot range relationship. So an unusually narrow pivot range is formed when the top, bottom and central pivots overlap each other, and it usually indicates that the market is all set for an explosive breakout opportunity. Therefore, it becomes highly beneficial to know when this relationship has formed. If you have studied the chart patterns and price action, you will understand that the consolidations and trading ranges leads to breakouts and range expansion. Essentially, what a tight pivot range is telling you is that the prior day was consolidating, which usually leads to a breakout on the day with the narrow pivot range given the right opening circumstances. And also, if you observe the charts, most trending days occurs when the central pivot range is considerably tighter than the prior day's range, especially if the prior day's range is unusually wide. So you can make use of screeners to look for narrow CPR in charts and then go into each chart to analyze them. Do keep in mind that the more narrow the range, the stronger the expected trend or the price move will be. Understanding how the current day's CPR relates to the prior day's CPR will help you go a long way towards understanding the current market behavior as well as future price movements. Actually, there are 7 types of pivot range relationships that should be considered when analyzing the current strength and the attempted direction of the market. So these 7 relationships are the higher value relationship, the overlapping higher value relationship, the lower value relationship, overlapping low value relationship, unchanged value, outside value, and inside value relationships. Each pivot range relationship brings with it a directional bias or an expected outcome, which you can prepare for certain types of trading scenarios in the upcoming session. Each of these 7 pivot range relationships depend on 2 important prices: the prior day's closing price and the current day's opening price. Where the market closes in relation to the pivot range gives you an initial directional bias for the following session, which you can actually plan for after the market closes. But it is only the next day's opening price that will either confirm or reject this bias that you had, which then gives you an opportunity to adjust for which type of trade you should be prospecting to. Now let's take a look at the first 2-day relationship, which is the higher value relationship. This relationship occurs when the current day's pivot range is completely higher than the prior day's pivot range. This means that today's bottom central pivot is higher than the top of the prior day's pivot range. This is the most bullish relationship of the 7 2-day combinations. Therefore, when this relationship develops, your initial directional bias will always be bullish. Also, if the price closed above its pivot range in the prior session, then we can expect that the market is positioned to move higher in the upcoming session. However, as I have mentioned earlier, how the market opens the next day will either confirm or reject this initial bias. So if the market opens the day anywhere above the bottom of the pivot range, you will only look for buying opportunities, preferably at a pullback to the range ahead of a move to the new highs. This is especially the case if the price opens above the top of the range. The simple fact that the price opened the day above the bottom of the range indicates that the market sentiment remained bullish overnight. When this occurs, any pullback to the range will likely be met with a responsive buying activity. But if the market had opened the session below the central pivot range, then a completely different outcome would have been the result. That is, the price may face a resistance at the CPR, and as a result, it can push the price lower because a change in the market sentiment has occurred overnight that caused the price to open below the range. The next pivot range relationship is the overlapping higher value relationship, which offers a moderately bullish outlook for the upcoming session. Now, this relationship occurs when today's pivot range is higher than yesterday's range, but it overlaps to some degree. Therefore, the top of the range is higher than the top of yesterday's range, but the bottom of the range is lower than the top of yesterday's range. The same closing and opening price dynamics are in effect for this relationship as well. So, if the market closes above its range in the prior session, a bullish bias should be assigned to the following day. However, where the market opens in the following session will either reject or accept this directional bias that we have had. The next type of pivot range relationship is the lower value relationship, which occurs when the current day's pivot range is completely lower than the prior session's range. This is the most bearish 2-day relationship, and it typically leads to further weakness given the current day's opening price confirms the directional bias that we have. So if the price opens the session below the CPR, we will be looking for shorting opportunities at any pullback to the range ahead of a drop to the new lows within the current trend. When you see a 2-day relationship that is clearly a lower value situation, it points to continued weakness in the upcoming session. As mentioned, the bias is confirmed by the fact that the price closed below the pivot range. Moreover, the price opens the current session below the CPR, which offers the best opportunity to sell a pullback if at all the price tests the pivot range. Even though the lower value relationship is the most bearish 2-day relationship, the opening price plays a very crucial role in confirming our bearish bias. That is, if the price somehow opens above the CPR, it indicates a drastic shift in the market sentiment overnight. And there is a great chance that the pivot range can now act as a support which can initiate responsive buying to the upside. The next 2-day relationship is the overlapping lower value relationship. This occurs when the current day's pivot range is lower than the prior day's range but overlaps to some degree. That is, the current day's bottom central pivot is lower than the bottom of the prior day's range, but the top of the current day's range is higher than the bottom of the prior day's range. Now, this relationship indicates a moderately bearish outlook for the upcoming session. That is, if the price opens within or below the pivot range, the price is expected to continue lower, and any pullback to the range should be seen as a selling opportunity. And the closing and opening price dynamics are in effect for this relationship as well. That is, if the market closes below the range in the prior session, a bearish bias should be assigned for the following day. However, where the market opens in the following session will either accept or reject our directional bias. Moving forward, the 2-day unchanged value relationship occurs when the current pivot range is virtually unchanged from the prior day's range. Of the 7 2-day relationship, this is the only one that can project two very different outcomes on the following day. On one hand, a 2-day unchanged pivot range indicates that the market is satisfied with the continuation of trade within the current or the existing range. When this occurs, the market will trade quietly within the boundaries of the existing 2 or 3-day trading range. On the other hand, however, a 2-day unchanged pivot range relationship can also indicate that the market is on the verge of a major breakout opportunity. Now, the outcome of this situation is typically driven by the opening price of the current session. So, if the market opens the day near the prior session's closing price, but well within the prior day's range, the market will most likely lack the conviction necessary for a breakout attempt. But if the opening occurs beyond the prior day's range or very close to the range, then the chance of a breakout opportunity cannot be denied. The outside value relationship happens when the current day's pivot range completely engulfs the prior day's range. This 2-day relationship typically implies sideways or range trading activity, as the market is happy with the current facilitation of the trade in the current price range. The huge width of the pivot range will also lead us to this conclusion as well, since a wide range will usually indicate range trading behavior, where the prices basically trade sideways quietly throughout the day. When this 2-day relationship develops, you can look to execute short straddles or short strangles to benefit from the premium decay, An exception is when a clear trading range has been formed, which can offer nice intraday moves within the boundaries of an established range where you can profit from short scalping trades. An important thing to keep in mind is that this relationship is much more revealing if the current day's price range is significantly wider than the prior day's range. Otherwise, just merely engulfing the prior day's range without the necessary width may even lead to the same result but with a very less accuracy. The last 2-day pivot relationship is the inside value scenario, which occurs when the current day's pivot range is completely inside the prior day's range. This 2-day relationship typically implies a breakout opportunity for the current session, as the market is likely to attempt a breakout. If the market opens the day beyond the prior day's range, there is a very good chance that the initiative participants will enter the market with conviction in order to push the prices to new values, since the market sentiment seems to have clearly changed overnight as indicated by the opening price. This 2-day relationship does not occur very frequently, but on days when it develops, this usually leads to major trending sessions. Now, the 2-day pivot range relationships offer guidelines for trading virtually any type of market condition, be it trending, breakout, and trading range. But it is up to you to properly interpret the 2-day relationship and apply confirmations before entering a trade. This is one of my favorite ways of using pivot ranges in charts. Using the CPR to gauge the market trend is extremely powerful. You may know from the basic price structure that an uptrend is characterized by higher highs and higher lows of the price swings, while a downtrend is associated with lower lows and lower highs of prices. When it comes to the pivot ranges, we can think of ascending pivots in case of an uptrend, where the centrals form a higher value relationship, or an overlapping higher value relation where the prices continue higher. On the flip side, we can think of descending pivots in case of downtrend, where the central ranges form a lower value relation or an overlapping lower value relation and the prices fall lower. As a matter of fact, I can remove the price from the chart, leaving only the central pivot range, and even then you should be able to tell what the market is doing and still make money. You can easily see the trends of the market and make money by only trading the direction of the prevailing trend. As you already know by now, the CPR can be one of the best sources of support and resistance in the market. Due to this fact, they can control the tide of the trend. Another thing to notice is how the price remains above or below the central pivot range throughout a trend until it either stalls or changes direction. So a strong trend can be usually gauged by how the price remains at or above the bottom central pivot in an uptrend and at or below the top central pivot while in a downtrend. Once the price violates this pattern by closing beyond the range for the day, we can observe either a change in the trend or a trading range market develop. Now, this behavior is a blessing for most swing traders, as they could enter the market once the pivot range is violated and then trade in the direction of the newly developed trend while holding their stop losses just beyond the opposite side of the central pivot range. For example, you can catch majority of uptrend using the pivot range by keeping the stop loss below the bottom central pivot. You would remain in the uptrend up until the prices close below the bottom central pivot, at which point you would liquidate your trade. One of the most common signals that you get associated with a change in trend direction is due to a narrow range CPR breakout. So if you know about the different market stages, starting from accumulation followed by markup or uptrend, then by distribution to markdown, and finally accumulation again. And if you don't know about it, you can watch this video on market structure from my free price action trading course. Do check that out after this video. Now, after a period of uptrend, for example, two things can happen. The market will take a breather, thereby forming a range or consolidation for a few days. Now, the problem is that this can either be an accumulation phase or a distribution phase. Now, if this is a reaccumulation phase, then we can expect a continuation of the uptrend. But if this is a distribution stage, then a reversal towards the downside is in play. This is where the narrow CPR comes into picture. So if you observe the charts, most often before a trend continuation or reversal after a consolidation, price forms a narrow range, thereby forming a very narrow CPR, due to which the prices explodes on that particular day, giving an idea about the direction in which the market will move in the upcoming sessions. In simple words, the narrow CPR decides the market trend for a short term. Now, you can use all these observations from the study to improve your analysis for the next day. Nowadays, on most trading days, the market gaps at the open of the session. When this occurs, you have two options: either to take a potential breakaway move from one of the floor pivots, or you can wait for the market to fill the gap. In either case, a gap at the open indicates that the market sentiment has changed overnight. One important feature of the CPR is that it has an amazing magnetic effect on the price, which leads to a high percentage fill of the morning gaps. So I have mentioned that CPR is an average price based level. So the central pivot range is the equilibrium of the market for that particular day. So if the price opens the day with a gap and the centrals are very close to the prior day's closing price, you typically see a fill of gap a high percentage of time given the right circumstances. This is like a magnet attracting iron nails. The centrals attract prices, causing the gap to fill. So all we have to look for is responsive market participants to enter the market and push the prices to the central range. Or in other words, we have to look for price rejections of newer values and let the market return to the fair value, which is actually the central range. Now, while this trade looks simple, there are a few additional tips that can help make this trade even more powerful as well as profitable. So for instance, trading the right size gap greatly increases the success rate of these setups. The gaps that are too large don't tend to fill as easily as those that are moderate in size. So it is better to stick to those gaps that have a fighting chance to fill, and the pivot range will do the rest. Secondly, the pivot range placement should be at or very near to the prior day's closing price. So when this is the case, the pivot range helps to attract the price to fill the gap. Also, you must remember that the goal of the trade is to play for a fill of gap back to the CPR, which means the trade will be usually very short. This indirectly means that you don't have to wait all day for a gap to fill, because the longer the trade takes, the more unlikely the gap is to fill. Another important point to note is that the trend can also play an important factor in the successful outcome of a magnet trade. If you recall from the trend identification part, when a market has formed an established trend, the price will usually pull back to the pivot range before resuming in the direction of the trend. Therefore, if the market has formed an uptrend and the price gaps up in the direction of the trend, there is a very good chance that the price will drop to the pivot range before another round of buying pressure is seen, thereby causing to fill the gap. This market behavior lines up perfectly with the idea of magnet trade. Another important factor to consider when trading this setup is looking for additional pivot confirmations that can add to the success of your trade. So if the price gaps up to R1 resistance or gaps down to S1 support, these floor pivots can serve as a barrier to the breakout trade, which usually leads to a high percentage of gaps getting filled. So knowing where these support and resistance levels are can help you give confidence in entering a trade, especially if the market gaps up at the open. On the contrary, any gap beyond these R1 and S1 levels, these levels will resist the price from reverting to the CPR and thereby eliminating a magnet trade. A CPR is called a virgin CPR when all the candles on a particular trading session have closed either upside or downside of the CPR, and none of the candles closed at the CPR, meaning that the CPR range was not tested even once in the entire session. A virgin CPR can act as a strong support or resistance for the subsequent few trading sessions. So whenever you see a virgin CPR on a stock or an instrument, you can extend it or mark it for the upcoming sessions. So when the price comes to that virgin CPR level, you'll probably see a very strong reversal. This is a powerful level to look forward to, as the price will respect this level once it reaches it and will most probably reverse from it. Now, one of the disadvantages of CPR is that you will not get a good result in a penny stock or a small cap stock because of the lack of participation or volume, which makes these levels less useful. So it is best to stick to indices like Nifty and Bank Nifty and those stocks only which has a good enough volumes. This is directly related to the way these levels works, as it is dependent directly upon the psychological value that the market gives to these levels, and the more number of people observing these levels, the better it will work. Another disadvantage is that you will not get an entry or exit solely from CPR. So CPR can act as a support or resistance to prices. So it is difficult to judge the trade direction within the CPR, and it is advisable not to take trades with a directional bias from inside the CPR range. Instead, we will use floor pivots for planning our entries, exits, and stop losses. We will now take a look at some of the general rules that we can follow while using the floor pivots for trading. Buy at support in an uptrend and sell at resistance in a downtrend. This is the most basic way of using floor pivots that can be easily overlooked, but it is one of the most powerful concepts that you can take away from using pivots. Essentially, we will discuss the concept of pivot filtering based on the current trend of the market. In a sense, we can filter out all other floor pivots below S1 while keeping the central pivot range and resistance levels when the market is in an uptrend. In a downtrend, all pivots are filtered above R1 while keeping all support levels and the central pivot range. Basically, filtering the pivots in this manner forces you to become disciplined to the trend, which increases your chances for a profitable outcome. The filtered pivots allow you to focus on playing the pivots that are more prone to reversals with the corresponding trend. That is, if you remove all the pivots below S1 support, you are forced to remain disciplined to a bullish trend by looking for long opportunities at S1 and the central pivot range. Likewise, removing all pivots above R1 forces you to prospect in the direction of a bearish trend, only looking for short opportunities from these levels. This seems like a very simple concept, but many traders can lose focus of the trend through all the noise that comes along with trading. The fact that when the market is moving within an established trend, certain pivot points become retired for that particular trend. It is at this point that your focus should shift to the pivots that are active for key trading opportunities. For example, in a bullish trend, any pivot level below S1 level is literally useless on your chart, since these levels are not tested during a true bullish advance. Likewise, any level above R1 is just noise during a bearish trend, as these levels are rarely tested during a true price decline. Therefore, if the market is trending higher, you will look to buy at the support at either S1 or central pivot range with your target set to R1 or R2 levels. Likewise, if the market is trending lower, you will look to sell at the resistance at either R1 or the central pivot range with your target set to a new low at either S1 or S2. You see, trending markets have a very interesting dynamic when it comes to pivots. As you have already seen, the market will remain strictly above S1 in a bullish trend and below R1 in a bearish trend. However, once a severe breach occurs through the first layer of pivots, you will see a shift of the trend towards the opposite extreme. That is, a bullish trend becomes a bearish trend and a bearish trend becomes a bullish trend. This type of analysis is extremely powerful for all type of traders, including intraday, swing or position traders. Another thing is when we are trading breakouts using floor pivots. What we are actually looking for is to see a gap occur between the prior day's range and value, preferably just beyond the first layer, be it R1 or S1 of the indicator. In addition to that, the gap should not be overextended beyond the second layer of pivots. That is, your chances for a trend day scenario increases if the gap occurs beyond R1 for a bullish breakout play, or if it forms below S1 for a bearish play. If the price gaps to the second layer, we will consider the trade only if the price tests any of the previous pivot levels that were surpassed via the gap and further move in the direction of trend with clear indications using candlesticks like pin bar setups. And if the price gaps too far beyond these levels, I would rather avoid trading on that day, because usually in such scenarios, market will begin to move sideways. The first strategy that we will discuss is the NR4 NR7 strategy. NR4 stands for narrow range 4 and NR7 stands for narrow range 7. This is a very popular strategy, and it is one of those strategies that helps to find the calm so that we can prepare and profit for the impending explosive price movement. We know that the market goes through regular contraction and expansion cycles. In this trade setup, we should patiently wait for the market to enter into the contraction phase, which is associated with a reduction in the range of the candles. Generally, we conduct the analysis based on the daily range of the candles. So the time frame that we use for our analysis will be a daily time frame. Now, the narrow range trading strategy is a breakout based method, which assumes that the price of a security trends up or down after a consolidation in a narrow range. We know from the previous sessions that when the range of the candles becomes lower, the CPR becomes narrower, which in turn confirms that a trend breakout is in picture. So the philosophy behind this pattern is same as Bollinger Band squeeze, which is a volatility contraction followed by a volatility expansion. So if you want, you can watch about this squeeze concept in the Bollinger Bands video. Now let us understand what exactly is NR4 and NR7. Now the following are the steps to identify an NR7 day. First of all, you have to get the high and low data of the last 7 days. Then calculate the range for each day. Now the range, as we know, is calculated as the difference between the high and low of the particular day. Now compare the range of today and the previous 6 days range. If today's range is smallest of all the 7 days that has been considered, then today is an NR7 day, else it's not. Similarly, when it comes to identifying an NR4 day, we have to get the high and low of the last few days. Then we have to calculate the range for every day and compare the range of today and the previous 3 days range. Now, if today's range is the smallest of all the 4 days that have been considered, then it is an NR4 day, else it's not. Now, one thing that we can observe is that as the range gets narrower, so does the CPR levels. So our objective is to look for narrow CPR which gets formed inside the range of the previous day CPR, thereby forming an inside bar like setup in the candlesticks. I would say an inside value narrow range CPR is very much stronger than just a narrow CPR that is formed at a random location. In some occasions, there will be more than one inside CPR or inside bar candles which gets formed, and this is an indication of a bumper trade because the market has contracted so much in volatility that there will be a very strong price move expected in either direction. Now, the direction of the price move is judged based on the previous day closing price with respect to the CPR, the 2-day CPR relationship, and the overall market trend. The trade idea here is quite straightforward, like the one that we adopt with an inside bar. We will look to buy if the price breaks above the high of the previous candle, and we will place the stop loss below the low of the NR4 or NR7 candle and try to capture the entire trend by trailing your stop loss at 1.5 ATR level below the candle. On the other hand, if the price breaks below the inside bar candle, then we will look for a short trade below the low of the NR4 or NR7 candles, keeping our stop loss above the high of the narrow range candle that we have considered. Here also we will look to ride the entire trend by trailing our stop loss. Even in case of a gap up or gap down opening also, the trade setup will remain the same. As a bonus, in order to identify the stocks with these trade opportunities, you can search for NR4, NR7 range screeners like those available in charting, and after finding such stocks, you can analyze if it fits your requirement, and if it does, then you can keep it in your watch list for tomorrow's trading session. The correlation trade setup is a very interesting trade setup, which is extremely profitable but at the same time rare in occurrence. Now, the idea is to use correlation associated with the index and its stocks. In this case, I will discuss only about Bank Nifty. We know that the Bank Nifty index is the index that tracks the banking sector comprising of 12 banking stocks, of which the first 5 stocks, which includes HDFC Bank, ICICI, Axis, Kotak and SBI, which contributes about 85% of the total weightage, and the top 3 banks contributes 62% of the total weightage in Bank Nifty. Now the trade idea is to use this relation. If at least 2 of these heavyweight banking stocks forms a narrow range for the following session, we can expect a similar price action in Bank Nifty index also. Do keep in mind that we have to look for very narrow ranges in order for a trending day to play out the next day with a good amount of confidence. So if 2 or 3 of these stocks and the index forms a narrow range CPR, and in addition if there is also an inside value relation, then we can expect breakouts in all these scripts, and as a result the index will move with a lot of momentum in either direction depending upon the stocks. In such a situation, you can take a trade in any or all of these scripts, or you can just focus on the index as it will move with a consolidated strength and gain a good amount of profits. Now it is up to you to properly interpret the CPR and floor pivots and apply proper confirmations before entering a trade. The faster you recognize the pattern of the market, the faster you will be able to deploy your strategy, because anybody can plot the floor pivots and CPR on their screen. But only those traders who have a keen understanding of the market's behavioral tendencies with respect to the pivots will profit by using these amazing levels. However, with continued practice, every opportunity will become an obvious opportunity. Do put in the effort to learn deeply, then backtest on multiple charts, and then test it out in the market by trading real time or paper trade, and improve yourself and your strategy. I hope this video was useful to you. If then, please do like the video and share it with your fellow traders. Don't forget to subscribe to the channel and enable the bell icon so that you won't miss out on any upcoming videos. I will see you guys in the next video. Till then, see you.